let's talk experience modification. And so what are we talking about here? This can be the most confusing thing, especially there's a lot of great information, on the WCIRB website, and I'm going to encourage you to go there. But I'm going to try and simplify it for you because it does get really, really confusing. So the Ex Mod is meant to represent a business's claim history and safety record as compared to other businesses in the same industry within the same state. So so now we go to the bullet point below. So the equation is the Ex Mod, as a lot of people refer to it, equals actual losses of the insured incurred over a 3-year period of time, and then you're going to divide that by the expected losses for their industry. So same industry. Let's just say you're a clothing manufacturer. Well, they actually, the bureau, they track all of that, so they know what the anticipated losses should be, the average in your industry, and they're going to measure that up by the actual losses. And that's really how the Ex Mod is determined. It's nothing more complicated. There's a lot more complication to how they address the claims type, small versus large, and there's a big formula to it. And I'm not going to waste our time with that because you're not going to be able to explain that to the insured very well. But you do need to understand that they're being measured. That mod factor is going to be determined by their actual versus what their industry is doing, and that can be a positive or a negative, right? Because that mod rate will ultimately, let's just say the base rate 1.00 is break even, right? You're not winning and you're not losing, so you would not have any debit or credit applied to your premium, but it can have a potential impact if you're having a lot of claims. Then you can really you will have a debit which will go above that 1.00 base mark, and then that percentage is what you're let's just say you ended up at 1.20. That would mean that you would have a 20% increase in your premium based on that mod factor. The other thing you need to know about the Ex Mod is that what you're looking at is a unit statistical report, and it's designed to calculate a company's experience modification. Let's just say we have a new business. It won't be assigned a mod rate until it's been established for a minimum of 3 years, and it has to have generated sufficient premium for each of those years. And generally, what I'm seeing, at least in California, it's slightly under around 9,000 in premium where you start to qualify. They've been lowering that down. It used to be higher, and so I have to go on and check to see what that number is. I think it was like 8,900, something like that number. So, and then you have to have that for 3 years. So. The other thing you really want to know is the claims. The claims activity is evaluated over a 3-year period, and the Ex Mod loss ratio will adjust accordingly at the 4th year moving forward. So it's like a rolling, it's a rolling impact that starts to impact the Ex Mod ratio after the fact. So that's why I was just using that other one as an example, is that you're rolling 3 years. So let's just say we have, you're already qualified for an Ex Mod. We're in the year 2020, and you start to have a series of claims that are significant, that are severity. And those will not start to hit until the next year. And then they will roll for 3 years. So you basically the insured will be impacted for 3 years, probably peaking at the height in the second year and then starting to come down in that third year, and it should fall off in that fourth year. And the credit, you will see more of a credit or a break even depending on where they are in their Ex Mod. So that's just an important thing to remember, because it's going to hit them later, not right away. The premium is usually what gets them right away. And then the Ex Mod comes in and kicks them one more time, unfortunately. So there's a lot of incentive to make sure that your insureds are not understand the depth and the problems, the cost involved with with having a lot of claims. A lot of insureds don't understand that, the impact of it, and a lot of times they don't even know, that they're not really understanding that a claim is hemorrhaged. So management of these claims is really important as well. So let's keep going. So this is one thing you guys have probably seen. It's a sample of the Experience Rating Form, and it's published each year for each insured that qualifies for an Ex Mod. And so a couple of things. It provides the details about classification codes assigned, the payroll reported for each of the classifications, summaries of the claims, and at the bottom you're going to see the experience modification, and you see down on 20, 19 is the experience modification, 20 is the equation that I talked about earlier, and how they got to the expected losses, and that number gets compared to the anticipated, and you can see that there is a this is not a bad account. I mean, they've got a 76% experience modification, meaning that they're going to have a 24% credit applied to their premium, and that's significant, and they're doing well with their claims. A few other things, beyond that, it would be a good tool to point out, how their claims are. If you could look at the claims and see by class code where they're having the problems, you can dig a little bit deeper on this. But this is an important rating worksheet, and you can get this from the Bureau easily.